Thank you very much, and good morning, everybody, and thank you to CEDA for the opportunity to speak to you today. And as an economist, and for other commentators, of course, there are plenty of things to talk about at the moment. And when I'm thinking about the outlook and how things have started this year, what is pretty clear, I suppose, that the same pessimism that's characterised views about the outlook for the Australian economy has carried over from last year into this year. We're seeing the same debate about the possibility of a recession happening in Australia, and yet again we're being told that the Australian housing market is in imminent danger of imploding. And it's easy to understand why, I suppose, because we're going down that same depressingly familiar path of seeing downgrades to global growth prospects, rising concerns about the outlook for individual countries, and plenty of financial market volatility to go with all of that. Now, having sort of dragged the mood down a little bit, let me lift it back up again by saying I think that 2016, the year ahead, will play out pretty much as 2015 did. And by that I mean when we get to the end of the year and look back, we'll see an economy that's probably running at around about 2.5% a year. So certainly it's below trend, and it'll be disappointing from that perspective, but it will be a positive rate of growth and a long way from delivering on those recession fears. Likewise, the unemployment rate, no doubt it'll be higher than we'd like to see at the end of the year, but I think we will look back and see a positive rate of jobs growth through that period. Now, that might sound a little bit optimistic, perhaps benchmarked against the volatility and concerns that we're seeing on financial markets, but equally I'd argue it's very hard to explain those moves in markets when you benchmark them against the economic fundamentals. Well, these couple of charts here just give you a bit of a feel for what is happening in the early part of 2016. So the chart on the left-hand side, for example, it shows you global growth forecasts for various years and how those forecasts have changed over time. And as you can see, there's a pretty standard forecasting rule that we all have, and that is you start off forecasting global growth to run at something like 4% a year around its long-run average. Then as reality catches up, we see this sort of long process of revising down those forecasts. If you have a look at the lines on the end there, the numbers for 2016, 2017, the same process seems to be underway. The chart next to it shows you a couple of measures of global financial market stress. Covers all markets, interest rate markets, currency markets, stock markets. But the way to read those charts, the higher those lines are, the greater the degree of stress in the global financial system. Clearly very high at the moment. And in fact, you've got to go back 4 or 5 years to find something worse than what we're seeing right now. But such elevated concerns, though, do seem a little bit out of kilter again with the economic fundamentals. So if I go back to those global growth forecasts, the reason they're being revised down right now is not because of any sort of general malaise that's dragging everybody lower. It reflects sort of specific developments, specific country factors. So not surprisingly, given where oil prices are, growth prospects for oil producers have been knocked lower. There are countries like Brazil that are in recession for a range of reasons. You've got to revise their forecasts lower as well. But get beyond those specifics, and the forecasts for most countries have been left unchanged. And from our point of view, the most important part of the global story, China, well, the numbers there have not been revised lower in this latest round. So, I mean, this is certainly something to watch because there is a risk here, of course, that this volatility feeds back into growth concerns, impacts on business and consumer confidence, and then does have a real impact on the economy. But right at the moment, it does look overdone. And when I speak to players in markets and ask them why we're seeing what we're seeing, you get two kind of standard responses, I suppose. People point the finger at the US and say, well, they're raising interest rates, and we're a bit concerned about what that's going to mean for the US and for the rest of the world. I also tell you they're concerned about China and the risks that policymakers there are a bit off track, and that the Chinese economy will continue to slow, and what that might mean. But again, I think these concerns need to be put into some sort of perspective, which is what I've tried to do on the chart here. So, for example, on the left, it shows you what's happening with US interest rates. So that little blip on the end is the rate rise that occurred in the US at the end of 2015. And yes, rates have gone up, and they've gone up for the first time since 2006. But reality is US interest rates are still very close to zero. even if we have 2 or 3 more rate rises this year, US interest rates will be extremely low. If I look at Chinese financial markets, well, the chart on the right-hand side there shows you a few indicators, plenty of volatility as you can see, but just to pick one example, the black line, what's happening with the Chinese currency? Well, it has weakened against the US dollar over the last couple of years, and that weakness has created a lot of ripples across global markets. But perspective, what that chart is telling you is the Chinese currency today is 8% lower than it was at the start of 2014. Over that same period, the Australian dollar has dropped by 22%, and nobody's really blinked an eye about that. In fact, most economists at least will actually see that as quite a good thing in helping the transition in the Australian economy. There is, I think, one lesson that we need to take away from this, though, when we're thinking about our businesses and the outlook for the year ahead. It's certainly the case that the aura of invincibility that Chinese policymakers once had has taken a big dent with their inability to control the stock market and some of the missteps, it seems, on the currency front as well. So certainly I think growth concerns will persist. But the other lesson here is that what happens in China is now not only important for global growth, but also for global financial markets. And just to try and connect with my children and prove that I'm all over the new technology and the like, if you do a Google Trends search on the words China economy, you get the green line on this chart. The other line, the purple line, is something called the VIX index. It's a measure of volatility in US equity markets, but it's kind of universally known as the global fear gauge. And what is interesting about the recent experience is that when you see those concerns about China lift, then that fear gauge rockets up as well. So you've got to watch China not just from what it means for growth, but also what it's going to mean for financial market settings from here, I think. Now, adding to the general fear is the collapse in oil prices. And certainly those forecasts out there a couple of years ago that oil was going to $200 a barrel have proved to be a little bit off the mark. And obviously it is bad news for oil-producing countries. But what has been absent, I think, from the debate is, well, lower oil prices are actually a positive for pretty much everybody else. And you're not seeing that reflected, I think, in market thinking or the general economic commentary. And again, just one example, the chart on the left-hand side here, the brown line, the oil price, I plot upside down, so as that line's going up, it means oil prices are falling. But when they do, you typically see growth in the developed economies. The green line on that chart move up as well. And when you think about Australia, again, most of our major trading partners are actually oil importers. Low oil prices should be a plus for them, and then by extension into the Australian story as well. And likewise, maybe US interest rates are going up, but the reality is that other major central banks in Europe and Japan are in fact cutting their interest rates and have pushed them into negative territory. And they're also pushing along with their quantitative easing policies, which basically involve buying government bonds with the idea of putting some downward pressure on longer-term interest rates as well. And when you look at the plans that these central banks in Europe, Japan and the US have about how many bonds they're going to buy relative to what's going to be issued over the next few years, you get a chart like the one on the right-hand side. And what it's telling you is these central banks are going to be buying more than all the new issuance. What that means, of course, it's demand and supply. Bond prices will rise, bond yields will fall. So those longer-term interest rates that are arguably more important when you're thinking about growth prospects for countries like the US and so on are going to remain very low again, whatever the Fed may do with shorter-term interest rates. Certainly, while stock markets and interest rates are getting all the attention, one area where maybe the bigger risk lies, I think, in the years ahead is in currency markets. And I say that because economists have long promoted the benefits of global trade in driving economic growth and the like. But the reality is, when we look at the data, this chart here shows, the brown line, global trade peaked as a share of global activity some time ago now, and it's really been tracking sideways since. I think what this is telling us is that that couple of decade period where we were building global production chains, global value chains and the like is pretty much over. They're finished. They're largely complete. So countries that have based their growth strategies on latching onto those chains and the whole trade backdrop there are now finding they're not getting much boost from that anymore. What's happening in a lot of countries, and particularly in the Asian region, is that growth is going to be more dependent on what's happening in the domestic economy. And the risk is that policies become more focused on, well, how do we capture all of that domestic growth and keep it in our domestic economy? And it's one of the reasons, I think, why pretty much everybody wants a lower exchange rate right now, because it's a good way of keeping that domestic growth within your borders. Now, we can't all do that, and so I think the risks lie here with perhaps increasing currency protection and the currency wars, if you want to go to that sort of extreme. So the bigger risk may be, in a financial market sense, coming through currency markets from here. Well, from what I've said so far, clearly we think most of the risks facing the Australian economy over the next year are sourced offshore, but there are some local issues that we need to keep a pretty close eye on, and those issues largely relate to the fallout from the end of the commodity boom, and that's reflected in two areas that I've picked out on the charts here. Falling commodity prices are a significant drag on Australian incomes. And the chart on the left-hand side here, it shows you the broadest measure of income there is. It includes everybody: household incomes, company profits, government revenues and the like. And the last few years have been the weakest period of income growth that we've seen since the early 1960s. And that income weakness, I think, poses a threat in the way we respond to it. Governments want to cut their spending. Businesses want to put off capital spending and labour hiring as well. So this income weakness can be a significant risk to key parts of the economic story. The other commodity-related event, of course, is the biggest mining construction boom that we've ever seen. Came to an end in 2012, and if you look at the green line on the chart on the right-hand side there, it shows you mining investment as a share of the total economy. Got to the highest level in 150 years. It's now falling. We think that peak-to-trough move will be about 4% of Australian GDP. Big number. In fact, it's bigger than the US fiscal cliff that everybody was focused on only a few years ago. And there's going to be significant job losses. Well, there are significant job losses that are coming through in that story, as you can see when you look at the purple line on that chart. Now, we're not particularly concerned about this capex cliff because we think we're basically going to export the problem. So, of course, as all this mining construction comes to an end, what we're getting on the other side is a big increase in our resource exports, and some of the numbers here are quite extraordinary when you look at what's going to happen over the next couple of years. And the chart here, just looking at our bulk commodities, so iron ore, coal, and of course the new bulk commodity LNG, that'll be an increasing part of the story. Well, the increase in production and export there is going to contribute something like 1% a year to Australian GDP growth over the next couple of years. That's a pretty powerful offset to that downturn in mining capex. The job losses, well, they're certainly happening, but we seem to be exporting the problem there as well, and so they're based on the chart on the right-hand side. So, for example, the green line, what we're seeing is that those really highly skilled construction workers who have been here on 457 visas are leaving, so they move on to wherever the next big project is, so we're exporting them. Turns out, if you look at the pink line, or the purple line there, a lot of these mining workers actually came from New Zealand, so they're now going back to New Zealand, and we've exported the problem to them. And if you look at the red line, well, the fly-in, fly-out nature of the workforce has also helped. That red line shows you the number of people flying into mining-related airports has dropped away. And what is happening, of course, is people are losing their jobs in the Pilbara where they work, but they're becoming unemployed in Sydney and Melbourne where they live. And if you're going to be unemployed, that's the best place to be right now because that's where the new jobs are being created. So it's helped, I think, absorb the stresses that would have occurred there otherwise. Well, it's a case of so far so good, but we do still need the transition towards the non-mining economy to continue. There's been three strands in that story that we've been following. We want to see an increase in residential construction. Well, that's happened. But as this chart here shows, the other areas that we were hoping were going to pick up was the blue line there, non-mining capital spending. Well, that's been pretty much dead in the water. And of course, the green line there, government infrastructure spending as well. There's a range of reasons why companies outside of resources have been reluctant to invest. But one of the big issues seems to be the very high hurdle rates of return that most companies still have when they're evaluating projects. You have to ask whether a 10 to 15% rate of return makes sense in a low inflation, low yield, low return environment. We do need to see some adjustments come through there. Likewise, the infrastructure part of the story in an aggregate sense has been disappointing. What that green line is telling you is that government capital spending today is actually about 30% lower than it was at the peak of the mining boom back in 2012. So rather than helping growth, it's actually been a significant drag. And when you think about the backdrop for infrastructure, well, it's a great thing in terms of providing a boost to short-term demand, but it also helps over the longer run by boosting productivity. Now, right now, governments can borrow 10-year money at 2.5%. If there isn't a whole range of projects that give us a better return than that, I'd be very surprised. And just finally, I want to say a little bit about the medium term, because there are some medium-term opportunities there that we shouldn't lose sight of, given the short-term focus that we have. And one of those is the shifting centre of economic gravity. Now, I think it's probably nothing new really, but I did find a very interesting way of illustrating that. Some work by McKinsey's, where they've worked out where the centre of economic gravity has been at various points over the last 2,000 years. And of course, what it shows is that centre of gravity moved from east to west with the emergence of Europe, UK, Industrial Revolution, then the US, of course. But you get to the 1960s and that westward march stopped, and it's increasingly moved back towards the east with the emergence of Japan and of course China and the rest of Asia. And you can see where they think that'll be in 2025, pretty much back where it started from. But the point I'd highlight here is it took nearly 2,000 years to go from east to west, but that transition back east is going to happen in 50 or 60 years, and you can do the calculations, and it means the centre of gravity is moving at 140 kilometres a year, so it's almost fast enough to see it happening. But the point I want to make is what is driving that shift back is the rising incomes in the Asian region in particular, and that's where the opportunities lie. Because we know as incomes rise, people want to spend more money on food, more of it, better quality. They want to live in bigger apartments, and you're going to need more steel to hold up those bigger apartments. They want access to education, and like everybody else, they enjoy going on holidays. They also typically spend more money on financial services and health as well. And as we heard from the Minister earlier, our expertise in the superannuation area is something I think will be highly valued in the region. We are going to have to pursue those opportunities, but they are there. And just one quick example to finish up, tourism. The chart on the left-hand side here, it shows you where tourists to Australia are coming from. And the red line there, the China line, of course, is the standout. Over the last 12 months, a bit over 1 million people from China have been to Australia for a holiday, which is a big number, but the good news is there's another 1.2 billion who haven't been as yet. So plenty of potential there. But what we've also discovered, the chart on the right-hand side, is that Chinese tourists actually spend more than any other when they're here. So it's more people who are spending more. It's been a very useful support of the Australian economy. It does illustrate what is possible. I'll finish at that point, and thank you very much for your time today.